this in so core areas of the syllabus, and then I thought I'd do a complete past paper, including the 3 sections: the part A, the part B, and the part C, covering the MCQs and the other questions as well. Yeah. Okay. So in terms of the core areas, I based on my experience, your examiner always tests 4 important areas here. The first is the area of capital budgeting or investment appraisal. The second is on sources of finance and about the cost of capital and capital structures. I'm keeping capital structures out of this lecture because it just takes a little bit of too much of time. So I just want to focus on the main areas. Anyway, capital structure will always be a theory-based question. Working capital management I'll be focusing on, and also foreign exchange risk management. Keeping in mind there's another part to that, which is the interest rate risk management, which I will not be focusing on this part because we've got about 5 hours to go through this entire thing. Yeah. Okay. So in terms of investment appraisal, all of you all know, when it comes to investment appraisal, every company has to kind of do investment appraisal. There are 4 commonly used techniques used. The first, obviously, is the more popular. I would say more popular. I would say the more the better version, which is the NPV, which kind of focuses on how much of wealth is created for the shareholders as a result of the decision being made today. Then we focus on the IRR, which is actually the more popular, practically more popular version that is used, which actually looks at the return generated on the project. And generally, if the internal rate is above the cost of capital, we generally say that the project is good in terms of an investment. And by definition, NPV and IRR for a single project does give you that same kind of conclusion. If a project's NPV is a plus, it's a go ahead. And if the IRR is above the opportunity cost of capital, it also signifies a go ahead. The problem that gets created when you're trying to choose between mutually exclusive projects, the NPV and the IRR can be a little confusing or give you conflicting recommendations at least. And that's where it's time to drop the IRR and just focus on the NPV. Yeah. Payback pretty much looks at, on average, how long does it take for an investor to recover their investment, right? Which is a little bit more popular when you're looking at times of risk and especially times of uncertainty where you like projects to pay back quicker. Yeah. And the ARR or the return on capital employed, which looks at your return on investment basically. Yeah. So plus you would also look at, how does this investment look at financially, so, and also non-financially, and what are the risks like before you obviously take that practical decision to kind of go ahead. Yeah. Right. Okay, so what is your net present value as a technique? It's based on the concept of discounting, which is basically trying to attach the time value of money. You're trying to take that into consideration. With time value of money is one of those very straightforward concepts that argues that the same amount of money received today is much better than the same amount of money received in the future, simply because where money received today can be invested for the future at a rate of return. So there is kind of an opportunity cost there. Yeah. Again, the technique only uses relevant cash flows. So in an exam, it's very, very important to focus only on the relevant cash flows. And your examiner will give you a lot of information for you to figure out kind of what is relevant, what is irrelevant there. Simplest sense, if you're trying to figure out something relevant, try to see if I'm going to make this decision, is this revenue going to be earned or foregone, or is this cost going to be incurred? Then it becomes relevant to that particular investment actually. Again, the technique uses an opportunity cost of capital. What is the opportunity cost of capital? You can think of it as a similar rate or a rate of return available on similar risk financial assets. Now, to to kind of show you what that means, yeah, uh, I can actually say that an expected rate of return is equal to always a risk-free rate, which is a rate of return for not taking any risk, which is basically a risk for a return for patience. You invest your money today, and if you're patient for the future without taking any risk, you should be kind of rewarded with a return. But on top of that, if you're taking a risk, you need to be given a risk premium as well in the process. So again, coming to the notion of opportunity cost of capital, what that basically means is, let's say if you're kind of an investor, you've always got kind of two broad choices you can make. One is you can invest in either financial assets or you can invest in real assets. Real assets are what we call physical assets. For example, in a straightforward sense, if you want, you can actually use money and set up a hotel. You can use the money and set up a business school, you know, set up a factory or whatever. You know, that actually becomes a real asset which generates a cash flow. But rather than investing in the real asset, there is another option. You can invest in a financial asset, and the financial asset is, for example, rather than investing in hotel, you can actually buy hotel shares. Yeah, and it's possible to work that return available on the hotel shares, right? So basically, if I know that the hotel shares give me a particular rate of return, rather than it actually investing in a project which is a hotel, I can actually invest that money in hotel shares, which means common sense will tell you that the hotel must minimum generate a return equal to the return on the financial asset, because that is the hotel's opportunity cost of capital. But obviously in this equation, there is one very important thing that must hold: risk has to be the same. Yeah. And in fact, that is exactly what IRR means. Now, for example, if I can invest in a hotel share, and if the hotel is giving me a 10% return, but obviously if the real asset is giving me a return of 20%, the IRR of that real asset is now 20%. And then, you know, it can be deduced that the real asset is actually giving you a return over and above that financial assets return. That's why we actually say when the IRR is more than the opportunity cost of capital, it makes sense to go ahead with that particular investment. Yeah. Okay. So that's what I kind of explained there. Okay. So then when we do net present value, we simply take the present value of the future cash flows, and you can either minus the investment cost, or if you can add the investment cost if you're considering the cost as a minus figure anyway, and that gives you the net present value. So the decision rule with regard to the NPV is simply pick on a project as long as its NPV is plus, because it adds to shareholder wealth creation today. And that's what the net present value is all about. So if you're trying to then choose between two mutually exclusive projects, one can always opt for the higher NPV over the other project, because the potential for creating shareholder wealth is much higher. Okay, so I went through this. Okay. Now, coming to the internal rate of return, well, the biggest difference I think between the IRR and the NPV is, whilst NPV is an absolute measure of wealth, an absolute measure in terms of either dollars or rupees or yen or what you want to call it, the IRR is now a percentage return. So since it's a percentage, it's one figure over another figure, meaning it can kind of hide size, you know. So an IRR on 10% of so an IRR of 100 million and an IRR of 50 million of both 10% is actually two absolute values. And that's why I think the IRR is a little confusing, because NPV is an absolute measure, while as IRR is a bit of a relative measure. Yeah. Again, a lot of people get confused. IRR is not a break-even point. The IRR is simply the rate of return which the project generates if its NPV is 0. That's it. Right. So by definition, if a project is generating a positive NPV, its IRR has to be higher than the opportunity cost of capital in its more straightforward sense. So in an exam, how do we compute the IRR? Well, we can go through a process of trial and error, whereby we first of all choose a rate which gives us a positive NPV, then an alternative rate which gives us a negative, and then we can use a process called linear interpolation, where we kind of work between the two rates. I mean something like this. Now, for example, let's say at a particular discount rate, you get a, let's say a positive NPV. You increase this discount rate, you get a negative NPV. So what's going to happen is you interpolate and your IRR is somewhere there. And that's what you're trying to do. But the reality is, so that's how we generally work out an IRR. Yeah? But the reality is that's how the actual behavior of time value works. So which means IRR is more an approximation than an actual value, because actual time value is a curved linear function rather than a linear function. Yeah. So it's more of an estimate, and that's why it's very, very important to ensure that there is no big gap between the two rates of discount factor 1 and 2. Idealistically, trying to keep this nothing more than 10% as a difference. Your payback period pretty much looks at how long before you recover your investment, right? Again, this can be computed in either present value terms or not. If your examiner is silent about it, just work a normal payback with non-discounted cash flows. Again, the decision rule is to kind of select a project as long as it pays back quicker than a target payback. Now, for example, if management has set a payback of saying, we are not looking at any investment of more than 5 years, and if this company's payback of that project happens to be something like 3 to 4 years, that project actually can be considered because it's falling within their purview. But that is its biggest problem. It's a very arbitrary measure. One person can say a project payback of 3 years is not enough, while another person will say 3 years is fine, because it just depends on that target cutoff that you're setting as a board of management, and it will grossly depend on your risk appetite and so forth. Your accounting rate of return is basically your return on capital employed, which is looking at your average profit over your average investment. Now remember, with average profit, this is the only time you need to consider depreciation and other kind of amortizations and so forth. Your average investment is your investment value at the start and the end divided by 2 in terms of how much on average during the period did you invest. Again, the decision rule is for you to select an investment as long as it's above your target return or your target return on capital employed. But remember, evaluating managerial performance on this basis can be very, very dysfunctional, because it doesn't actually encourage long-termist behavior. In that respect, something that does encourage long-termist behavior is the net present value, because as soon as a company undertakes a project with an NPV, if a market is efficient, we should see its share prices rising by the value of that NPV. And in fact, if you're actually trying to reward managers based on an accounting rate of return or whatever, the dysfunctional behavior that will get created obviously is some kind of incentive to manipulate profit, or trying to keep your investment value low, because the lower the investment value, your ARR may be higher. And obviously, the more we skimp on investment today, that is at the expense of future growth as a business. Right, so that pretty much covers that in terms of important things. Later on, when we're doing a simple question, we will focus on that. Especially when you're dealing with any question with regard to NPV, it's very important for you to understand how to deal with a capital allowance, how to deal with inflation using either nominal or real cash flows. That I'll be focusing on a little bit down the line. Back again, how to do capital rationing, because there can be certain situations where the companies are limited for funds and either doing soft rationing or hard rationing. So you've got to know what these differences are. You've also got to understand how to incorporate working capital into these calculations, and you've got to understand also how to make lease or buy decisions with this, and also how to deal with assets, investments that are not of equal lives actually by using something called the equivalent cash flow or equivalent annual cost techniques and so forth. Yeah. So now I've looked at sources of finance. Well, every business needs finances if you are to run your operations. And to be very honest, it's not the finances that are really important. It's the assets that are needed to run a business. Financing simply looks at how is the asset going to be funded. That's it. Because at the end of the day, in any business, what really generates money is its assets, which generate an operating cash flow on that assets. The finances are put in place simply to ensure proper funding of the asset takes place. That is why that's why a balance sheet works that way. Liabilities are the finances, which represent kind of the assets on the other side. Yeah. Okay. So basically, when it comes to finances in a business, we focus on mainly two types of finances. We have equity sources, which represents the owner's money, the owner's capital. And obviously we have debt sources and other sources, which could be even a preference share can be categorized as a debt source. Actually, it's more prior charge capital, but it could be alongside debentures, bonds, bank loans, or whatever you want to take it. Yeah. So the characteristic is that generally debt does not get involved in running a business. Once debt holders are paid off, they should be happy with their returns. They only get little activated, obviously, if their debt has been in default or the payments are in default. Or debt holders, worst case scenario, which they can do is obviously impose certain conditions or covenants, which you have to fulfill. As long as those amounts are fulfilled and these guys are paid on time, you shouldn't have much of a problem with them. Yeah? Or if you really want them to remember you, don't pay them. Right. Again, debt will always be a primary claim on the cash flow generated on an asset. So what happens is any business has an operating cash flow, and once this cash flow on operations is generated, providers of finance have a claim on this cash flow. And the first claimant or the first source of finance you need to satisfy in a business is the debt holders, because they have a primary claim on the cash flow. And most of the time it's a primary claim, but it's also a fixed claim. So once that fixed claim is satisfied, that's it. You pay them in full. They do not participate in surplus profits unless and otherwise it's a source of finance like Islamic finance, which is actually working on the concept of justice and fairness and so forth. Yeah, so that's where the sharing of risks and rewards occur. Yeah. So when it comes to the and obviously I've also looked at here that there are many factors you need to consider when you choose finances for your business. I've just listed some of them out here. You know? So one important thing is you always look at, do you have the capacity to take on debt? For some companies, their gearing levels are already too excessive. It's not the gearing level to be concerned with, it's the interest coverage ratio. So if the interest coverage ratio is low, it means you're kind of struggling to pay off that debt. So, you know, if you're trying to push the boundaries of debt a little bit more, the chances are you'll be in default, and obviously the debt holders will make the firm bankrupt. Yeah? You've also got to see what kind of signals you're sending, and this is a little bit more academic, but generally what we see is that debt sends a bit more credible signals to the marketplace, especially when a market suffers from information asymmetry, where the outsiders cannot judge the quality of a firm. So a lot of managers end up choosing debt as a credible signaling effect, because only managers in charge of high quality firms and who are averse towards borrowings, especially because they can lose their jobs also, will be willing to take high levels of debt because they have the capacity to pay so. Another thing is to look at, obviously, is the cost of capital now and other issue costs. Now, for example, debt is, in that respect, is a very, very relatively cheaper form of finance to actually raise, because the issue costs are much less. Now, for example, if a company is actually trying to go for a share issue, you could be paying as much as anything between 8 to 10% of the issue value as your issue cost alone, because you're talking about you know, accounting fees and stock exchange fees and marketing costs and so forth. But when it comes to debt, sometimes the issue costs are much, much less, something in the tune of, let's say, sometimes even 3 to 5% of the value could be kind of the issue costs. And also the cost of capital itself. Now, down the line I come to consider the cost of capital, but equity holders take the highest risk in a business. That's because equity is a residual return. So whatever is left over is what comes to the shareholder. So there can be periods where you earn a lot of money. There can be periods actually where you earn nothing. So to compensate this risk, any equity holder will demand higher returns, and that high return which you have to pay to your shareholder, your providers of finance, is kind of the cost of capital to that company. So since debt holders are taking much less risk, these guys are happy with a lesser return in line with that risk. Are there any agency issues that are created in the process? Yeah. Now, what we see is things like debt. When a company has very little debt, there is an agency cost created because managers in charge of these firms are not motivated to perform hard, because these guys work hard and outside shareholders kind of take the returns. But if there is debt in the too much of debt in the capital structure, managers of these firms actually are motivated to take on higher risk investments because they can share the risks with the debt holders because there is limited liability, but not the returns, because returns to debt holders will always be paid kind of a fixed amount. Just give me a second. Amrit? Yeah. Again, another thing which you would like to focus on is what are the terms and conditions with the kind of finance that is coming. Now, sometimes the problem is debt can come with a lot of terms and conditions in the process. Yeah. Another thing also for you to focus on is, obviously, do we have the collateral to offer? If you look at a company's balance sheet, sometimes the balance sheet is very weak because there are no assets to give. And if there are no assets to give, you may not be able to go for any debt financing, in which case you will have to look at some form of equity. Most of the time in those cases, you'll have to look at something like a venture capital. Also, how quickly do we need the finances? Now, equity issues may take a lot of time to raise because of the formalities involved. But debt, sometimes if your relationships with the bank are quite strong, it's much quicker to raise. Again, the state of capital markets. Obviously, if your capital markets are not performing well, it's very, very unlikely that a equity issue is going to work. In those scenarios, you may decide to go for a debt issue. And in this case, not even a marketable debt, but rather something like a bank loan, which is raised kind of indirectly. Again, how do we exit? Because for example, if it's a venture capital, how do you exit? Because most of the time, venture capitalists, you'll have to either buy them out, or they will motivate you to go on a stock listing and they will sell out themselves, which means there can be a change of ownership in the company. And also, what is the business risk of the investment? Now, generally, business risk later on, which you will see, is kind of in any business, the cash flow generated on your assets is never ever going to be a constant. It's always going to fluctuate. And in some businesses, this fluctuation is very, very high. Now, for example, if you take something like tourism, there is always a fluctuation in the cash flow. It's never a constant amount because tourism is one of those businesses that has seasonality. And it's also a very, very susceptible business to any kind of, environmental or economic change. Economic conditions falling could mean that people do not have disposable income to travel, political uncertainty get created around this. Even as simple as, something like a disease spreading, whereby certain parts of the world will not be very favorable in terms of traveling, weather conditions, you name it. So in a business like that, with your cash flow fluctuating, it's not a wise thing to commit yourself too much to debt. And that is why we say, if your business risk is high, you need to kind of limit your financial risk in terms of gearing, right? And obviously the dilution of control, where now if you issue debt, there is no dilution of control. But as soon as you invite somebody else onto your board, you're going to have a problem. And obviously, what is our risk appetite and attitude? So the company is very conservative and they have a very, very low risk appetite and are not going to take risk. You may decide to use honestly retained earnings or not even, or just equity. But if you have a relatively higher risk appetite, you may decide to go for debt financing. Right. So that's what I've explained here. Debt is a very, very versatile source of finance, but because it offers you many benefits, one of the biggest benefits being the tax benefits, right? And also it gives you a certain degree of financial leverage, because with your operating cash flow increasing, you don't need to share that with your debt holders. Everything else becomes residual to the shareholders. But the problem is you have a commitment now, and if these commitments cannot be settled properly and you cannot reschedule your loans, your company can be bankrupt. Yeah. Right. Again, debt has to be repaid. Debt is again less expensive. They enjoy a fixed claim, and the debt is deductible against tax. Yeah. I've discussed here quite a lot about the advantages and disadvantages of debt. I just went through some of them. Now, important concept to understand, the post-tax cost of debt. So the post-tax cost of debt is very useful simply because, let's say each time a company borrows money, let's say if you have to pay your debt holders at 10% return, this is the pre-tax cost of the debt capital of the debt you're using. But if you're paying taxes at the rate of 30%, because you're paying that debt interest, your tax liability can reduce by 30%, which means though you paid 10%, you save taxes at the rate of 30%, which means you effectively only paid debt worth of 7%. And that is what we call the post-tax cost of debt, generally worked out as the pre-tax cost of debt into 1 minus t. I've also discussed a few different types of debt here. You can have deep discounted bonds or zero coupon bonds. Now, deep discounted bonds meaning the bond pays a very low coupon rate of return. And in a zero coupon bond, you don't pay no return at all, actually. It's just that the investor experiences a return either by issuing it at a discount to its face value today, or in the future, even redeeming this at a premium. Very important to understand is this notion of the convertible debt. Now, convertible debt is what you call a hybrid, and a little bit more on the financial innovation side. In a convertible debt, if you issue a convertible debt, it gives its holder the right, but not an obligation, to convert it to a predefined number of shares in the future. So it's up to the holder of this convertible to decide whether they wish to convert this or not. And obviously the decision to convert will be always looking at how many shares am I going to get in the future, what will be the rough estimated share price in the future, and by looking at, is it worth to convert? And if it's worth to convert, then naturally their conversion will occur. So why do companies issue this? Well, for companies, the issuing of a convertible debt can initially keep their coupon rates low because there's a bit of a sweetener attached to it, and also it's kind of a bit of a backdoor to issuing equity down the line. I've also now looked at equity finance. Well, equity represents ownership, and with ownership comes controlling rights, the right to vote, and also to the right to a dividend, the right to an annual report, and so forth. So the biggest advantage of an equity holder is if your company is doing well, after all other liabilities are settled, the residual is all yours. I've looked at now the advantages and disadvantages. One of the greatest advantages you'll have of equity is, if your business is not doing well, there is no compulsion whatsoever for you to pay dividends. There can be pressure for you to pay dividends, it's a different story, but there is no compulsion for you to pay dividends, unlike debt interest. So just because a company has not paid a dividend, it does not give shareholders the right to take legal action against the firm, but debt holders certainly can. Yeah. But on the flip side of this, there is no apparent tax benefit of it, and each time you issue it to equity, there is a dilution of control, and not only is there a dilution of control, there's a dilution in your EPS as well. I've also discussed a little bit here about different kinds of share issues. Yeah. Very important concept to understand is in your exam, we can look at how do you deal with rights issue. So what is a rights issue? It is an issue of new shares to existing shareholders, and that's the key word, existing shareholders, in proportion to their existing shareholding. So which means if you're issuing shares to existing shareholders to motivate your existing shareholders to buy the share, you have to issue this at a value less than its market price, because if you issue it at the market price, there will not be an incentive for shareholders to buy this, because they might as well buy it at the market price, as simple as that. So which means always a rights issue will go below its market price, and that's its problem, because if you're issuing a share below its market price, what's going to happen is it has to settle at a value between the price you issued and the price in the market before you issued, and that price is what we call the theoretical ex-rights price. So if you break it up in words, in theory, what should be the price after the rights, post rights? Yeah. Generally, how we work it is, now for example, I've worked it out here. If you're trying to issue one new share for every 4 shares held, what's going to happen is you'll have 4 old shares at 6. You're issuing 1 new share at 4, which means you've got now 5 shares worth 28. So each share should roughly be around 5.6, and that is what we call the theoretical ex-rights price. Will this be the price of the share after the rights issue? Not really. In theory, we could expect it to be this much, because all other things being equal, right? So what is the value of a right? Well, the value of a right is technically, if you have a right and you do not wish to participate in your right, well, you can sell this right to somebody else. It's kind of like a car permit. If you have a permit, you have a right to buy this car at a lower price. But if you don't want to buy the car at a lower price, you can actually sell the permit in the market for a particular price. So you can think of a shareholder also trying to sell this share in the market, or the right in the marketplace, and that is the value of a right. Common sense will tell you, let's say anyone who's now how we work the value of a right is the difference between the theoretical ex-rights price and the issue price. Now, for example, in my scenario here, the theoretical ex-rights price is 560, and the rights issue price is actually, in this case, 4. So which means the value of a right in this case will be 1.6. So what that logically means is someone who's buying this right from you is going to pay 1.6 and also pay 4 to buy a share, which means his total cost is 5.6. But if his cost was 5.7, he will say goodbye to those rights, because he can actually buy the share at 5.6 in the market. I've also looked at a little bit about the efficient market hypothesis. The efficient market hypothesis simply argues to what extent information is accurately reflected in prices, because information is what moves prices in share markets. So if you had actually looked at the share price movements within the last 2 days, the information of a new president being appointed and so forth has made the stock markets move. So information is what actually moves the stock markets. But interestingly, if there was kind of expectation that a particular candidate was going to win, stock prices will start to move from those days onwards, because prices reflect information expectations as well, basically. And if those expectations are in line with if what actually happens is in line with those expectations, there is no reason for prices to move any further, because those have already been reflected. So what we generally say is, if a market is efficient and if all available information is actually reflected in prices, no investor can make above average returns by buying or selling investments. In fact, the word above average returns means you earn an NPV of 0. on the buying or selling of a transaction. Does this mean that you incur a loss, or is it even worthwhile buying? Well, it is. Try to understand, if an NPV is 0, the IRR is equal to the opportunity cost of capital. What that means is you are getting a return exactly in line with your next best alternative use, which in economics we refer to the word normal profit. So, NPV of 0 and a normal profit is actually synonymous, it's one and the same thing. So then, to test efficiency, a lot of researchers like Pharma or Eugene Pharma, as a researcher, plays around with different forms of efficiency, which actually deals with different types of information. In a weak form efficient market, we would expect at least historical information to be reflected in prices. So in such a market, no investor can use historical information, especially past patterns and trends, to make gains. In a semi-strong form market, we expect share prices to speedily and accurately reflect the arrival of new information. Now, what is new information? Something unexpected. So this new information could be either good or bad, and either way, we would expect share prices to absorb that information quickly. Strong form implies that stock prices already reflect all available information. Remember, the word is all available information and not all information. We are not expecting investors to be soothsayers and be able to forecast the future, but whatever is available should be available to all. There should be information symmetry. So if a market is efficient strong form, we would expect prices to also reflect inside the information which is available to just insiders, which means nobody can now make above average returns by kind of using any form of information available whatsoever. So that's exactly how it builds what's weak form. So if a market is semi-strong form, it's already weak form efficient. And if a market is strong form efficient, it is already weak form and strong form efficient, because it's building at just different levels. That's it. I've also discussed now the important concept of the cost of capital, and the cost of capital just means that every time a company uses sources of finance, there is a cost, and that cost is, in a competitive capital market, if a company is trying to attract finance, these investors, rather than investing money with that company, there is an opportunity cost where they can invest that money elsewhere to earn a return for the same risk. So if a company does not give investors that return, the investors are going to take their money elsewhere and invest it elsewhere. So cost of capital just refers to one straightforward thing. If I can estimate how much of returns my investors are demanding for the risk they take, I have kind of solved that puzzle and understanding as a company how much of a cost must I give. So if I take the notion of a shareholder, if my shareholder can invest elsewhere for the same risk and get 25% as a return, I need to minimum give him 25%. So now then a student will ask, okay, if I give this guy 26%, will that shareholder be happy? Of course he will be. That is because you've taken the shareholder's money, you've invested in a project that projects internal rate of return of 26%, and from that 26%, you're giving the guy 26% when he could have got 25% elsewhere. That creates a positive NPV for him, and it's just that. But when it comes to something like debt, it gets a little different, because, okay, let's say a debt holder is demanding a 5% return based on the risk they're taking, because they can earn this 5% elsewhere for the similar risk. So should the company give 5%? Yes, the company must minimum give 5%. But don't forget, if the company has a tax benefit, or the company paying taxes at 30%, you can save taxes as well. So when it comes to the cost of debt capital, we should be playing around with the post-tax cost of debt. Finally, since a company is a pool of finances from different sources, it's very important that we work out an average cost of finance for all of these sources, and that average cost of capital is called the WACC, or the weighted average cost of capital. It's the average is weighted by significance, and that's where each weightage comes. For example, if equity is 70% of your capital structure, your cost of capital should edge more towards the cost of equity than anything else. So then I've discussed here a little bit about estimating the cost of capital. We need to estimate cost of debt, cost of equity, and cost of preference shares. Yeah. Now the cost of debt capital is very straightforward. If it's based on book values, we can take the face value of the rate we are paying and adjust that for tax. But if it is based on, if the debt is marketable, now what is marketable debt? Well, certain debentures, investors can buy and sell it on the market. So which means who determines the market price of a debenture? The market, based on demand and supply. So based on the way the demand for that company's debt moves or rise or falls, the market price of that debt can get affected, and through that market price, companies can be signaled what kind of rates of return the market is looking at in terms of their investment. So when it comes to the market value of debt, it's very common to work out the internal rate of return the debt holder enjoys as a rate of buying this debt. What is the internal rate of return? It's also called the yield to maturity, which is basically if an investor buys the debt at today's market price and holds it till it matures, what's the rate of return they're earning on their investment. So it's the IRR of that particular investment. So for a company, you'll have to offer this rate of return to keep your investment happy. But don't forget that if you have a tax benefit, you should be taking the post-tax cost of that. Now, the cost of equity capital, again, is if I want to keep my shareholders happy for the risk they are taking, how much is the return which I need to give them? Well, to work this out, there are multiple ways we can do it. Each has its own methodology, has its own set of assumptions, but it's very, very common to use two approaches. One is called the capital asset pricing model, and the other is called the dividend valuation model. So in reality, if the markets are in equilibrium, the answer you get through a CAPM and the DVM will both be the same actually. So what is the CAPM? The CAPM argues that an expected rate of return is a risk-free rate plus a risk premium into a beta coefficient, or what we call the stock's level of systematic risk. Now, what is systematic risk? Well, when it comes to investment, there can be two types of risk, what we call the idiosyncratic risk, which is a risk that is specific to a particular company, or which can be actually diversified if you hold a big portfolio of investment, because these risks don't correlate with one another. The residual risk, or what we call the systematic risk, is a risk that is exposed to all companies and industries, which affects them to a greater or lesser extent. Now, for example, interest rates affects everybody, exchange rates affects everybody, but some companies are more affected than others. Now, for example, if you take oil prices affect even the supermarket because transportation costs is affected. But certainly if you're an airline, you'll be a little bit more affected because your main business as a commodity revolves around that. So which means we can then turn around and say that you have a higher systematic risk towards that given macroeconomic variable, causing your systematic risk to be high. And that systematic risk is kind of what is captured in the beta. Then with regard to the dividend valuation models, I can't go into the mathematical derivations of this, but depending on whether it's no growth or with growth, there are different calculations we can do. So the preference cost of capital is worked out the same way, because a preference share is a known dividend, so it's a fixed return. Plus it's something that does not grow, which means when we want to work out the cost of preference share capital, we can use the dividend valuation model without growth, because there is no growth in dividends. So I've done a summary version of all of this, of how to work the different things. So it's a summary of it all. Lastly, I also looked at the WACC. The WACC is nothing more than an average cost of capital. So what that basically means is if a company has a WACC of 10%, what that means is if you're taking investors' money and if you're investing that money in projects, those projects must generate a minimum rate of return of 10% to keep all your providers of finance happy. So obviously, if the project is generating more than 10%, not only are you meeting their minimum requirements, but giving them something extra, which obviously is now creating wealth for your investors. Does it make sense? But it's a bit of an important thing actually, because you must understand that WACC is based on the risk of your existing assets. But if this business is moving to a new risk class of assets, then it's a little questionable to use that WACC, because it can be a little misleading. In fact, doing so gives you what is called either over or under investment, and that's what I've looked at here. So what happens is something like this. Now let's say the WACC is irrespective of the risk of the investment you're undertaking, right? But you know, in reality, how it works according to CAPM is, the higher your systematic risk, the higher the return you demand. So let's say at this point, you can see that's the beta of your existing assets. Now let's say if you are evaluating a project which has a higher systematic risk, that is the return you should be using. But if you are using the WACC return, you are actually using a low discount rate, meaning you result in something called over investment, because you are actually doing too much of investment because you've used a wrong rate. The same way, if you undertake another project which has a lesser risk, that's the return you should be using. But if you're going to be using the WACC, you are now going to have a situation of underinvestment. To overcome this problem, your examiner sometimes throws this section of geared and ungeared beta. Now, what is geared and ungeared beta? Well, any balance sheet, you will have a situation where sources of funds will equal users of funds. So if you take shareholders in a firm, the shareholders' volatility to their dividends or their investment is caused by broadly two things. First thing is, right, the nature of the assets your investment represents. Like I mentioned, some businesses, the cash flow generated on the assets can be very volatile. In fact, when the cash flow on your assets is volatile, that is what we call business risks. Okay, but on top of that business risk, if you have if you are a company that is all equity financed, in this case, the risk of your asset is exactly transferred to the risk of your liabilities, causing your asset beta and your equity beta to be one and the same. And that's what you call an ungeared beta. But if a company has debt in its capital structure, or if a company has many assets now, let's say what you mean by many assets, it's very common for certain companies to have investments in more than one industry. Each of these industries can have a different level of systematic risk in terms of how cash flows fluctuate. Now, for example, if it's industry one, if it's something like John Keel's, there may be a higher cash flow fluctuation with hotels if it's industry one. But if industry two is actually something like Keel's, which is actually in most supermarkets, which is more considered a necessity, the cash flow fluctuation there could be much less. Yeah. Or let's say if industry three is, I don't know, something like Ceylon cold stores. A little difficult to say how soft drinks would work, but if it's something like drinks, I would expect the volatility to be very high in terms of cash flow there. So what then happens is we can have what we call a portfolio beta or a weighted average beta. If the company is all equity financed, that should now equal the equity beta. But the complication comes when you have a geared beta. That is, now on your liability side, you will have assets on your asset side, but your liability side now can consist of debt, which can have a debt beta, and equity, which can now have an equity beta. So in these situations, it's very common that the asset beta is a weighted average debt and equity beta. But what can happen is so then we end up with a bit of a complicated equation like this, which is not very complicated actually, because then asset beta is a weighted average equity and debt beta. That's what it's shown above. It's very common for us to assume that the debt beta is zero sometimes. Debt beta is zero means the debt is risk-free, which means there is no default, which means the entire risk of the business will now be transferred to the equity holders, making the equity beta quite high now. Okay. If the debt has a tax shield, we need to adjust for the tax benefits through wherever you see the word market value of debt, you should be multiplying by 1 minus t. Next section which I've looked at is as a little bit on working capital management, which is sometimes operationally very crucial, because if a business does not manage its working capital, you can be technically insolvent because you don't have liquidity to kind of operate your business. Yeah. Now, what is working capital? It's the capital you need to run your day-to-day business activities actually. So generally we take working capital as current assets, is the current investment in current assets, but net working capital can be worked out as current assets minus current liabilities. So as I mentioned, if a business does not maintain its working capital properly, you can have liquidity issues, though you're profitable. I mean, in straightforward sense, as soon as you look at the company's balance sheet, P&L account, you will see a massive profitability in its operations. But if you look on the other side, they are either running overdrafts or the debtors level is very high, bad debts are very high, and so forth, meaning they are running into huge liquidity issues because all the goods have been sold on credit and none of the cash has been collected. So in the long run, what's going to happen is, how are you going to pay those salaries? How are you going to pay your light bills and so forth? So again, I've looked at here a little bit about the importance of working capital management, because for some businesses, current assets comprises the majority of your total assets. Now, for example, if you take something like a car sale, if you've got about 50 or 60 high value cars there, the majority of your investment is in current assets, which is stocks. And if these are not moving, you've got problems, because a lot of money is tied up in those. And if a lot of money is tied up in those and the stocks are not moving, how is the business now paying its employee salaries and so forth? Again, shareholder wealth is more related to cash flow generated in accounting process, and we saw this. See, at the end of the day, something like net cash flow, something like NPV, is what creates the wealth generation, and wealth is an outcome of cash flow rather than profits actually. And again, failure to control working capital has been one of the biggest causes of corporate collapses. What's the main objective of working capital management? Well, the objective is to balance two conflicting ends. On the one side, you're trying to balance profitability. On the other side, you're trying to balance liquidity. And it's two opposing forces. Now, for example, if a company holds a high level of, so if a company wants to increase profitability, one of the easiest ways to do this is sell your goods on credit. But as soon as you say, you are running into a liquidity problem because all the money is tied up and you don't have money to run your business. Same way, if you want to maximize your profitability as a company, you can hold on to massive levels of stocks. But what happens is, since the money is now tied up in stocks, your liquidity is compromised, and vice versa. Now, when it comes to working capital, there can be what is known as an investment and a financing decision. The investment decision pretty much looks at any point in time, how much of working capital do we need to hold, like how much of stocks do we need to have in place, how much of debtors do we need to have in place, and it's mainly a function of the industry or in the time of business and so forth, levels of technology you're using. For example, if a company is using something like JET, you don't need to hold on to high levels of inventory because it's a smoother system of operating. The other is the financing decision. So the financing decision pretty much looks at how am I going to fund the working capital? And obviously, when it comes to funding, you can broadly choose between short-term and short-term and long-term sources of finances to fund this. And that is why, based on this funding, we can have different kinds of working capital management policies. Now, as a general rule of thumb in finance, it's the matching concept. It's kind of very important for you to match assets. You have to match short term with short term, long term with long term. Now, for example, if you're buying something like a car, it doesn't make sense to buy the car on an overdraft. Well, you can buy it on an overdraft, because if an overdraft is demanded, if you have to pay it back quickly, you will have to now take another overdraft to pay that overdraft off, lead into a bit of an instability situation. Then you might as well, put in finances to fund the life of that asset, which in this case could be something like a lease over about 4 to 5 years. So generally, as a general rule of thumb, we should match short-term assets with short-term source of finances and long-term assets with long-term sources of finances. Okay, so I've discussed that yes, short-term finance are very, very attractive because they are much easier to raise, they're much cheaper, no collateral needs to be offered, and it's very, very flexible. Now, there's an important concept to understand, the concept of fluctuating and permanent current assets. Now, in any business, there is like to be fixed assets and there is like to be current assets. Now, with current fixed assets, there is like to be also weirdly something called permanent current assets, and you'll have fluctuating current assets. Now, for example, everyone can turn around and say that stock is a current asset, but for some businesses, there are always stocks that they are holding at whatever time of the year. So which means anyone who's walking into a warehouse, if they are seeing a particular stock every day, it gives you that illusion that it's permanent, it's throughout the period. Debtors can be also throughout the period. Why? Today I can sell on credit and next month I can recover the money, but by the time I recover the money, I've sold on credit again. So which means at any point in time, there will be a certain amount of debtors that are outstanding. That is what we call the permanent current assets. So it's very common then for a company to finance its fluctuating current assets with short-term sources, but the permanent current assets and the fixed assets now with long-term sources. Important concepts now to understand when we are managing our working capital, because our working capital generally consists of 4 important elements, what we call our debtors, our stocks, our creditors, and our cash. So this section I've just briefly looked at it all. Now, for some businesses, debtors is very, very significant. You know, if you take something like, let's say, Dialogue in Sri Lanka, their debtors level can be very, very high. What's the debtors level? You take your sales, divide it by 365, and multiply it by your debtors payment period, which shows you at any given point in time, on average, how much of debts are outstanding. So it's kind of like a permanent current asset there, right? Again, when we are in for most practical situations, when we are considering our average collection or average creditor level, average debtor level, which you read here, it's very common for us to take the average value, which is the value at the start and the value at the end, divided by 2. Again, if we are holding on to debtors, we need to fund this. The idea behind funding, if people owe us money, we have a cash shortfall. Shortfall has to be bridged in some way. One way to bridge it is you putting permanent forms of finance in the form of equity to bridge that shortfall, or just like what a lot of companies will do, either use a bank draft or delay payment to creditors. Either way, you're funding your debtors. Now, how do you, so for some businesses, like I mentioned, if debtors are such a big value, how do you manage your debtors? Well, it's very important for any company, first of all, to have a policy with regard to your debtors. Otherwise, if a company does not have a policy, you will react to different situations in different ways. You want uniformity in whatever you do. Otherwise, you'll be looking at each debtor's face and saying, look, you qualify, you don't, I like you, I don't like you, that kind of situation. You want this uniformity. So it's very common for a lot of businesses to first of all say, okay, who is to qualify for credit? If so, what is their credit limit? If so, are we going to charge interest for late payments? Are we going to give discounts for early settlement? If so, how much is the maximum discount we are going to give? What are collection procedures? By what time do we write off a debt? Or what levels of debt do we commence legal action on? I mean, if somebody is owing you 1,000 rupees, it doesn't make sense to take legal action for 100,000 rupees to kind of correct that. Understand? Otherwise, there's something honestly wrong with you, or you're a very vindictive person. Right, then obviously once you've got that in place, you need to assess the credit worthiness of your customers. Do they are they worthy of giving credit to? And generally, well, we can look at what we call the 5 C's. The 5 C's are the character, the capacity, the collateral, the capital, and the conditions. And for example, some business shows their characters are is so bad with regard to their name in the marketplace that no one actually wants to do business with them, or actually just give them credit basically because they have such bad trade references kind of. Or some businesses can be in certain industries where the industry unfortunately is not doing too well. So those industries, companies may decide not to extend credit to. Or like I said, some companies, their balance sheet is not very healthy, and you may not wish to give them enough, or you may not wish to give them credit. That's why in practice we use techniques like Altman's EZ scores and all to determine whether companies do qualify for credit based on balance sheet ratio figures. Then we need to also look at effective invoicing procedures, and also monitoring the date. So send the invoices on time, because if you're giving your debtors 30 days to pay, 30 days starts from the time you send the invoice, or from the time they receive that invoice or whatever. So if it even goes to doing electronic means, by sending this invoice ASAP, and also monitor the debt, see how much has been outstanding, for how long has it been outstanding. Perhaps if it's outstanding for too much, it's actually time to write it off, or if it's outstanding for a long time, try to offer discounts for early collection and so forth. Maybe actually worth it. And also you need to have your debt collection procedures. So if an amount is outstanding, I mean, you don't immediately take legal action. You may first of all do reminders or phone calls, sending more formal letters. Again, you can follow it up with a bit of a stronger letter, ends up with a bit of a personal visit. Now it's time to get into legal action. If that's not working, go for debt collectors or collectors, where you can actually outsource certain people and collect this money. Not the nicest people, but got to be done, I guess. Giving discounts for early settlement. Now, sometimes in your exams, it's a very common area where your examiner asks you, is it worthwhile? Now try to understand, if you're giving a discount, there is a cost, and there is a cost of that discount itself. But is there a benefit? Yes. Because if I give a discount, what's going to naturally happen is the debtor's level is going to fall. So let's say earlier, if customers were paying me in 60 days, now I'm giving them a discount of 2% if they pay me within 30 days, I would see my debtors level harden. And if it does harden, what's going to happen is I can save finance costs, because earlier I could have relied on the bank overdraft for this or another form of finance. So which means you're always trying to compare the benefit of reduced financing cost versus the cost of actually giving the discount. And if you think the benefit outweighs the cost, I think it makes a lot of financial sense to go ahead, but the non-financial aspects also need to be looked at. Like, for example, there could be a situation where certain customers can take the discount and still take up to 60 days to pay. Debt factoring is something a lot of businesses in the modern world can actually consider, because the modern world seems to be running on a lot of outsourcing arrangements. The more flexible our companies are, and the least number of people we have at head office and run it as a very flexible operation, the more we should have a competitive advantage in our marketplace, because we should be able to concentrate on our core competencies, allowing another business to concentrate on their core competencies. So debt factoring is pretty much that, where you can actually consider outsourcing debtors to a reputed third party. So what happens is this particular agreement can always be of three parts. First of all, the factoring company itself can look at an administration of debtors. So they will take over your debtors function. They will do the invoicing for you. They will do the credit screening for you. Do the entire administrative part of it, which is generally charged as a percentage of turnover. On top of that, they will also enable you to enjoy a certain degree of liquidity. Why? Rather than waiting for the debtors to pay the money in the future, they can advance an amount upfront. Usually it's a percentage of, let's say, 70 to 80%, which they may advance upfront. Obviously they will charge you interest on that, but still you have liquidity to run your business now. So then once the debtors pay, the balance will be given to you. But that balance also, it depends on whether the agreement is with recourse or without recourse. So that simply means if the factoring company is the one who's taking the responsibility for the bad debts. So if they are not taking the responsibility, or if they are taking the responsibility for the bad debts, it means that does not come back to you, which means it's without recourse. But if the factoring company is not taking the responsibility for the bad debts, the factoring arrangement is with recourse. I've also discussed now about managing stocks. So when it comes to business, depending on the type of the business, there can be three broad types of stocks: materials, work in progress, and finished goods. Yeah. And I've just discussed how to work out each of the different levels of stocks which you're going to hold. Now, for some, if you're something like a brewery, your work in progress stock levels is very, very high, because some of these breweries, now, for example, if you're, in if you're supposed to call yourself a single malt whiskey, the minimum period your product has to be matured is a minimum 3 years, and some of these people mature for more than 12 to even 18 years in the process. So that's quite a significant work in progress stock period actually. Again, I've discussed here, high levels of stocks can boost your sales, but also there are so many other costs. For example, if you're a mobile phone manufacturer, the cost of obsolescence is always high because the technology keeps changing. The chances of theft, because if you're holding on to stocks, chances are a few will go missing. There's pilferage that is taking place. Over that holding cost, the insurance, the electricity, the security guards, all those things added now. For example, if you're selling something like diamonds or jewelries or expensive watches, just even try to think of the holding cost needed in terms of the security systems. I've also discussed now different stock management models or approaches. Now in this, your examiner is very it's very common for him to test the EOQ, where he says, should the company depart from the traditional way it's currently ordering towards the EOQs, we've got to know that. Sometimes your examiner does test a little bit about different stock levels, maximum stocks, minimum stocks, and so forth. So I've looked at some of these things. So your EOQ, what is your EOQ? It is an optimum order size, which kind of to be placed at a given time, which kind of minimizes or minimizes both your holding and the ordering cost of stocks per annum. So again, it's a model based on several restrictive assumptions. One of the biggest restrictive assumptions is that your demand throughout a period is evenly spread actually for the units, and none of the other variables actually change. So if in a business where your demand is volatile during a period, it's very difficult for you to hold on to this economic order quantity because of that assumption. So how does it generally work? Where what we see is, if you take cost versus an order size, you will see the more I order, my ordering cost will reduce, but the more order sizes, my average stock is increasing and my holding cost is increasing. So the EOQ is where your holding cost and your ordering cost is at its lowest point. And that's where the holding and the ordering cost is equal. And that's what we're always trying to do. I've also looked at order levels. It's very common for a lot of companies to set order levels. They have a maximum stock, they have a minimum stock, and they have a reorder level. So basically how it could look is, for any business, you will have what is called a reorder level. So at this reorder level, it's time to place an order for new stock. Then you will have a minimum stock, which is your buffer stock in terms of the most minimum quantity you're holding. Then you will also have a maximum stock level, which is basically you should not be holding more stocks than that. So then what happens is your stock levels can now fluctuate. So when your stock level is fluctuating, at the point of reorder level, you place a new order, and hopefully that's your reorder quantity. So the reorder quantity can be the EOQ or something else. But it takes time for the stock to come, and the time it takes for your stock from the time between you placing an order and getting your goods is called now a lead time. Calculating the levels. Now, as I mentioned here, we can work out your reorder level, your minimum stock levels, your maximum stock levels. It's important to kind of understand this for MCQ questions and so forth. Managing creditors. Well, what do you mean by managing creditors? Well, logically, you can't manage creditors because creditors manage you. But managing creditors means creditors can be a very useful ally in your business. always try to, you know, try to collaborate. You know, there are always benefits to collaboration than competing. You know, you don't create enemies in business. It's a little important for you to kind of use your creditors and the credit they give you as a source of finance, because sometimes it can be cheap. Because when see, logically what's happening with regard to a creditor is, if you owe a creditor money, it means if you're not paying him, he has invested in your business for which he's actually not getting a return either. So the creditors being nice actually, but what do you do? Rather than, what a lot of businesses at least do is, rather than using the creditor source of finance, they tend to abuse it. So that's why I've said here, use the creditors wisely, use the creditors effectively, don't abuse them. So sometimes what can happen is, now to a lot of businesses, one of the easiest ways they can expand their businesses is by delaying payment to the creditors. So what you're doing is you're making the creditor a shareholder in your business without effectively giving him shares and not giving him a return on his investment. So obviously what happens in the long term is you're going to kind of have bad kind of, you know, trade relationships with these people, and obviously, like we saw on debtors on this side, your character as a business is getting a little affected. And a lot of firms, when they try to use their creditors more and more, that is the area you're moving into in what we call undercapitalization or overtrading, which I will effectively touch on now. Right. Again, in your exams, though I haven't mentioned it here, your exam can sometimes ask you whether it's actually worthwhile for you to take a discount for early settlement from your creditors. Well, you can then wait and see, because as soon as you take a discount, that credit level you're having is reducing, which means that reduction has to be financed some other way. And that finance can sometimes come in the bank overdraft as a cost. As long as that cost, extra cost, is much less, or the benefit is much less than that cost of taking the discount, you still might as well go ahead with that taking the discount. Plus, there could be so many non-financial factors like strengthening relationships with creditors even further. Cash management in any business, you need to manage cash. Little difficult to manage cash because in some businesses the cash flow is very unpredictable. But in theory, your demand for cash is actually three ways. One is, has to be kept with you for a transactions motive to do your day-to-day transactions. The precautionary motives, that's the big if in case something goes wrong. And the speculative motive, because sometimes good deals come your way. If the cash is in your hand, there's so much you can do. So when it comes to managing cash, you can have actually two approaches. One is called the Baumol model, which takes the same approach as the EOQ model for stock. Again, if you're using the Baumol model, we are assuming, just like the EOQ, that my cash disbursements during a period are constant. So the Baumol model will kind of work out like the EOQ, how much should be the optimum cash replenishment at a given point in time, versus the Miller model, which is more frequently tested in the F9 papers. It looks at what if there is volatility in cash flow, and that looks something like this. So with regard to your Miller model, what you're trying to establish is what you call an upper limit, a lower limit, and a return point. Each of these is calculated through formula, and which is also available in your exams. Note that if you're using this this equation, that interest rate should be the daily interest rate if your variance of cash flows is daily, and generally it's very common to take it as daily. So what happens in this Miller model is, over time, you will now have a lower limit, you will have a upper limit, and you'll have this return point. So what happens is, that's your spread. So the difference between the upper limit and the lower limit is your spread. So what happens is, the cash flow is allowed to wander between the lower and the upper limit. Now let's say if the cash flow has reached the upper limit, it signifies that you're actually holding on to too much of cash. And that's the time for you to bring the cash back again to the return point by now investing in that surplus in short-term securities. Then again the cash flow can fluctuate, but if it hits a low limit, it means you're holding not enough cash. That's the time to sell short-term investments and replenish the money. So let's bring it back again to return point again. So like this is how the model works. And to work those values out on it, I have shown those equations there. Yeah. Again, note, if your examiner has given you the standard deviation, take the standard deviation and square it to get the variance. I've looked at certain working capital ratios and indicators. Very important ratios are the current ratios and the quick ratios. Also, your examiner frequently tests the cash conversion cycle, which looks at how long before you recover your money and so forth. Overtrading I have discussed here. Basically, every business, when you want to grow your business, the growth has to be accompanied with investment. So each time a business grows, it's very common when your turnover is growing for your stock levels to grow, your debtors levels to grow, and so forth. But a lot of businesses, for convenience, what they do is they try to fund this growth through short-term sources. Well, like I mentioned, it's cheaper, it's quicker to raise, and so forth. But what happens is you're exposing yourself to the risk of overtrading, because the biggest weakness of short-term source of finance is very unstable, and there is always a refinancing risk associated with it. So if a company is trying to expand its growth, you might as well rely on long-term sources as opposed to using short-term sources, especially because the increase in working capital, remember, can have a permanent component, permanent current assets. So I've also discussed certain symptoms of overtrading. Sometimes in an exam, you may wish to calculate certain ratios to understand whether that organization is overtrading or not. Also, lastly, I've looked at here exchange rate risk management. Now, in today's world, a lot of businesses have moved outside their home countries, or globalization has involved them trading with at least one country. Because the world has become the marketplace, converging demands, and so many things, reduce transportation costs, right to government policies which encourage multinationals to operate and all, has opened up the world to foreign trade. But with that comes another risk, which is foreign exchange risks, because currencies keep fluctuating, and sometimes for certain currencies this fluctuation could be so bad, where you can have one rate in the morning, one rate in the afternoon, one rate in the evening, and so forth. Or honestly, a rate can change while you're in a queue to change currency. So again, what determines exchange rates? Well, just like any other commodity, it's mainly demand and supply. So today, ironically, I was trying to convert some money, and I was asking, what the dollar rate was, 180 or something. So then this person actually said, there is a chance that the rate can ease out because they are expecting dollar inflows into the country. So to be seen. That's it. Okay. So obviously what happens now is I've looked at this diagram. This has looked at the demand for sterling, and it looked at the supply of sterling. So each time you notice that, so the price here, interestingly, is not the price of the dollar. Why? Because it's dollars per sterling. So this is actually the price of the sterling. I could have shown it the other way around. If I had shown dollars per sterling, I would have shown sterling per dollar. That could have actually been the price of the dollar, and that would have been the demand and supply for dollars. So the diagram will actually look at the other way around. So when I say dollars per sterling, that is what we call the base currency, and it's very important to understand that simple notion. Yeah. So you see here, if it's the demand and the supply for sterling, each time the demand for sterling increases, the price of the sterling must go up. And if the price of the sterling has gone up, we actually say that the sterling has appreciated or the dollar has depreciated. Either way you're correct. But if so, why would the demand for the sterling appreciate? Well, for starters, if the British economy is doing well, the sterling should be rising. But right now, even with things like Brexit, that's another questionable thing. Yeah. Again, I've looked at this simple concept of exchange rate quotes. Now there can be what is called a direct quote or an indirect quote. Nothing to get confused too much here. Now, for example, in Sri Lanka, we quote direct because we always say how many for local currency units to one foreign currency unit. So it's always how many rupees per yen, how many rupees per dollar, how many rupees per euro, and so forth. But countries like the UK are very common to code indirect, where they show how many domestic units or how many foreign units to one domestic unit. Yeah. Again, big difference between what we call spot rate. So a spot rate or spot is right now. So spot rate is a rate quoted now for an immediate transaction, but settlement can take 2-3 days, but it's a rate quoted now. A forward rate is a rate quoted today, but for a transaction in the future. So that's what a forward contract is. And generally there are ways to price forward contracts. So in your exam, pricing a forward contract, your examiner asks you to use interest rate parity for you to work a forward rate. I can't do that. Now, when it comes to exchange rate risks, there can be three broad types of risks a business can face. One is transaction risk, which is basically you get into a transaction today and money is going to change hands in the future. If in the future exchange rates change, there is a risk. Translation risk is a little different. You are a subsidiary, you have operations in different countries, you need to consolidate, and each time you consolidate, depending on rates, assets or liability values can change. That's the translation. Economic risk is the most complicated, I guess, of them all. Economic risk can even apply to a company that is not dealing with forex, because economic risk is how changing interest rates can affect the market value of a firm. So if exchange rates move in a particular way, a business's future cash flows can get affected, and that can affect the market value of a firm, because the market value of a firm is logically the present value of future cash flows. So in its more simplest sense, let's say for some odd reason, in something like the Maldives, if the rupiah strengthens against the dollar, tourists may find it a little difficult to travel for holidays to Maldives, and that can cause the hotel's cash flows to fall and the market value of the hotels to drop. I've also discussed different methods to hedge the risks. You can use a lot of internal techniques, which is basically, using your internal treasury or yourself. Most common are invoicing in home currency, where you transfer the risk to another party. Bilateral and multilateral netting, which is practiced by multinational organizations. Leading and lacking, which is basically it's changing the timing of a payment. If you think your home currency is going to appreciate, it makes sense for you to delay a payment. But if you think your home currency is going to depreciate, it makes sense for you to lead or to make the payment immediately. So if you think it's going to appreciate, lag the payment or delay it. If you think it's going to depreciate, lead the payment or make it early. Matching is you try to match foreign currency assets and liabilities and so forth. Now, for example, if you're a company that is going to is invoicing to an American customer, and this American customer is paying you in dollars, but you have a supplier who you buy from, which requires you to pay in pounds. Well, you can actually look at whether you can invoice the American customer to pay you in pounds, so that once you can take this pounds, match it with the other side. Restructuring is where you try to, it's a more long-term thing, where you try to restructure your business by reducing your exposure in certain markets where exchange rates are not in your favor, or you're trying to restructure your balance sheet by foreign currency denominated loans and so forth. External hedging techniques, one of the most common techniques is forward contracts, money markets, currency options, futures and swaps. Those things I will just look at briefly. So I just discussed internal techniques. Forward contract. What is a forward contract? It's something you enter in today, which is a binding contract for a transaction in the future. No payment is made today. All the payments occur in the future. You just contractually agree on a rate that's called the forward rate. Irrespective of what the future spot rate is, the forward rate, the transaction has to occur at the forward rate. So given this inflexibility, there can be situations of gains and losses. A money market hedge is, well, what is a money market? A money market is a market for dealing in relatively short dated funds, highly liquid market. So it's short-term depositing, borrowing. So in the money market, what a company can obviously do is kind of borrow or deposit in different currencies and create an artificial hedge kind of, or create a lock-in. So it's kind of it's a bit of a homemade forward contract if you think of it in that way. Now, a lot of students get confused. What do you borrow in? What do you deposit in? Well, the easier, do not be motivated by the rates. Just because the sterling pound is a lesser rate than the US dollar, don't be motivated to borrow in sterling and deposit in dollars. What you must do is base it on the matching concept. What I mean by the matching concept is, if you're going to have a dollar asset in the future, it's best to create a dollar liability to match that asset. The same way, if you have a dollar liability or vice versa, that's kind of how the matching works. But like one of example, let's say a British company is going to actually has to pay a supplier in the US in 3 months time in dollars. So the best thing to now do is, if you have a dollar liability in the future, you might as well create a dollar asset today, so that once that dollar asset matures, you can settle the liability. So if you're creating a dollar asset, that's the time you need to deposit in dollars but now borrow in sterling. But if it's the other way around, for example, if an American customer is going to pay you in dollars in 3 months time, in the future you have a dollar asset, you can now create a dollar liability today, which means creating a dollar liability would now mean borrowing in dollars, depositing in pounds. Why again would you borrow in dollars? Because if you borrow in dollars, you will have to pay a borrowing in 3 months time, but not to worry, you are getting dollars in 3 months time, which you can set it off by. Futures contracts. So what are futures contracts? Futures are like forward contracts but traded on recognized exchanges. So a futures contract is a very standardized contract, standardized in terms of a contract size and a date or an expiry date. So generally futures are traded 4 times or the contracts are for 4 times a year, coinciding with the quarters. But it is possible at any given point in time to buy and sell. So the mechanisms of futures trading is, you can either buy futures today and reverse out by selling futures, which can create a gain or loss. Or if you sell futures today, you can reverse your position by buying it in the future, again creating a gain or loss. This gain or loss created on the future will now, or trading will now set off against the kind of the currency situation in the future. That's how it technically works. Right. Again, I've just tried to explain how these futures prices behave. Notice I've used some actual data here. I've used a Standard & Poor's stock index future. You see what's in red is the futures price or spot price. So if futures is what you call a derivative, so futures are a derivative. A derivative is an asset whose value derives from the value of another asset. That asset is called the underlying asset, which is called the spot asset today. So the futures price depends on the spot price. So you can actually see here over time, there is a difference between the futures price and the spot price. In fact, this difference is called the basis. So, and you will see here, this basis is not linearly. So at the time of expiry of the futures spot price and the spot price will be one and the same. But you can see here it's gradually reducing over time. Is it reducing in a linear fashion? No, it doesn't, because it's a time value. Since it does not reduce in a linear fashion, that is what we refer to the term as basis risk. Options. What is an option? Unlike forwards or futures, which are generally obligations, an option gives you a right whether you want to close out or not at that particular price. So generally when it comes to options, the only problem with an option is this flexibility comes at a cost, and that cost is called the option premium. The option premium is something the option buyer pays the option writer or the underwriter, which is also called the option seller. So there can be again 2 types of options. There can be what is called a put option, which gives you a right to buy something, or a call option, which gives you a right to a put option which gives you a right to sell something, or a call option which gives you a right to buy something. So in its more straightforward sense, let's say you are a UK exporter and you're going to get some dollars in the future. What you want to do with the dollars in the future is one of two things. You are either going to sell dollars or you're going to buy pounds. If you're talking of options in pounds, since you want to buy pounds, you want a right to buy pounds. You can take a call option on pounds. Or if you're getting dollars and you want a right to sell those dollars in the future, you can take a put option on dollars. That's it. And depending on the future spot rates, if it's in your favor, you may decide to go at that exercise price or not. And that's what I've discussed here. What is a swap? A swap is where one party exchanges cash flows with another party. So in a classic currency swap, there will be a swap at the start and a swap at the end of the capital amounts. Very important to also understand this thing called the theoretical forex relationship, which you examine a frequent test in MCQs or sometimes at the end of certain forex questions in part either B or C. What is this theoretical relationship? It looks like that. This shows you, okay, so the relationship between interest rates and inflation rates is shown as the Fisher effect. That's 1 plus m equals 1 plus r into 1 plus I. The difference between interest rates can show you how future forward rates are going to move. So if one country has a higher nominal interest rate than another country, you could expect that country's currency to depreciate in the forward market. The difference, so that's called interest rate parity. The difference between inflation rates is known as purchasing power parity theory. Now, purchasing power parity theory compared to interest differences is differences in interest rates show you the forward rates. Differences in inflation rates will show you the likely movement in future spot rates. So there is a difference. So if when you generally want to forecast future spot rates, it's better to use inflation rate differences. In fact, where the common sense is, if one country has a higher inflation rate than another country, goods in that country are expensive, exports will fall, and if exports are falling, the demand for that country's currency will fall, causing that country's currency to depreciate. That's the theoretical thing. But obviously, if you take this as a four-way equivalency, so that's called purchasing power parity theory. If you take this as a four-way equivalency, expectations effect seems to suggest that in the future, the expected forward rate and the spot rate could be one and the same, because what could also happen is if investors looking at the forward exchange rates, if they see that a currency is depreciating, their own actions of buying and selling can make that currency depreciate, making the actual spot rate move in that particular direction. Going that way, which means there's a final relationship that way. So if this four-way equivalency does hold in the long run, what's going to also happen is real rates of return across all countries or currencies are also now going to be the same. And that's called the international Fisher effect. Okay, so that's equal, that is equal. Okay. Right. Any questions? Yeah, anything to ask? Because what I want to do now is kind of take a little break and then come back and practice a paper which kind of well brings in most of these things we actually looked at. Yeah. Amrit. Amrit. That's okay. Right, so welcome back. Okay, so what I want to do now is just practice a bit of a paper actually. It's really. So this is the paper I wanted to just try with you all, September 2016. So let's kind of go through the MCQs. Let me just open up an Excel sheet as well for this. Okay. Right. Let's see what these questions are. So the first is basically the owners of a private company wish to dispose of their entire investment in the company. They wish to, so we are supposed to look at the net realizable, what is the minimum price per share which the owner should accept for this company. Now to work this minimum price per share, what we can do is we can first of all, if you like, work out the book value of this share. So to work out a book value, right? We can see we know the non-current assets, so that's 30, plus we know the current assets, that's 18, minus we know the non-current liabilities, which is 12, minus 10. That should give us a book value of 26. Notice the company has the shares are worth 1 million 50 pence, which means we have 2 million shares. So the value per share is basically, in this case, 26 divided by 2, which gives me a value of 13. But if I'm to work on the net realizable value, you'll notice what they're telling you here is the net realizable value of non-current assets exceeds book value by 4 million, which means this will be 34 because the book value is 30, so it's 34 plus my current assets are 18, but the current assets include 2 million accounts receivable, which is thought to be irrecoverable. So that will be 18 minus 2, which is 16, minus, in this case, 12, minus 10, that should be 28. So the value per should now be 28 divided by 2 million shares, 14, which means basically this company should not accept less than 14 because that's kind of the minimum value, because that's a value you should be getting, because anything less than this doesn't kind of make sense. So your answer is answer A. Yeah. Right. Which of the following financial instruments is not traded on a money market? So what's a money market? Like we mentioned, a money market is something for trading in relatively short dated funds. The commercial papers are traded on short-term money markets because the commercial paper is a short-term unsecured borrowing by a company. Yeah. Treasury bills are also short term. Certificates of deposits are also short term and high big value items. So your correct answer here should be convertible loan stocks, because convertible loan stocks are kind of traded on capital markets, right? Andrew Company is a large listed company financed by both equity and debt. Which of the following areas of financial management will impact on working capital management the smallest? Will logically dividend policy should be our answer, because everything else is more along the lines of working capital management. Yeah. Which of the following is a description of basis risk? Remember, basis is the difference between a futures price and the spot price. And over time, what happens is at the point of expiry, this basis becomes zero, or at the point of convergence. So the answer 1 actually says it is the difference between the spot exchange rate and the futures rate and the currency futures exchange rate. Well, that would have been correct if it had just said what is the meaning of the word basis. So what they're asking is for basis risk. So that answer is kind of is out. The second thing is saying it is a possibility that movements in the currency futures prices will be different. Yes, it is different because it does not move in a linear fashion. 3 says it is the difference between fixed and floating rates. No, that is wrong, because it's not. It is one of the reasons for an imperfect hedge. Yes, the answer is correct, because at any point in time, if there's a difference between the spot price and the futures price, what can happen is there can be an imperfect hedge. Only at the point of convergence is there a perfect kind of hedge. So which means any answer, which in this case is 2 and 4, seems correct. Answer C. Craig Company has 200 million per year, so the gross profit margins are 40%. Fixed in inventory, finished goods inventory days vary throughout the year, so there can be a maximum level of 200 and a minimum level of 90. So it says in relation to fixed goods inventory and assuming a 360-day year, how much finance will be needed for the overdraft? Now they've told us Craig intends to finance permanent current assets with equity and fluctuating current assets with its overdraft. So what we can do is kind of a calculation like this. Yeah, we can work out the minimum stock, because that's kind of a buffer. So to work out this minimum stock, that will be equal to, in this case, paper. Yeah. In this case, it will be, yeah, it will be, I need my cost of sales, which is basically in this case 200 into 0.6. That figure I will divide it by 360. I believe it's 360 days. Is it? Yeah, assuming a 360 days, so 360. Yeah, and multiply that by, in this case, 90 days. So which means that's 30. The maximum will be pretty much the same thing. It will be 200 into 0.6 divided by 360 and multiplied by 120. Sorry. So that's 40, which means the difference is, this is the amount which I need to fund now through my bank overdraft, because We are trying to find, we are financing the permanent part. So the permanent part here is 30. This 30 can fluctuate to 40, which means that balance of 10 is the fluctuating current assets, which means your answer here is answer A. Okay. Okay. 6. Okay. In relation to an irredeemable security paying a fixed rate of interest, which of the following statements is correct? As risk rises, the market value of the security will fall to ensure investors receive an increased yield. So as risk rises, see, as soon as risk rises, investors start demanding higher returns. As soon as you start demanding higher returns, since the value of a security is the present value of the future cash flows, the value of the security will fall. And if the value of the security falls, investors will now receive an increased yield on it, because the yield and the prices seem to be inverse related. So that should be our correct answer. Yeah. So our answer is answer A anyway. Top companies switching from using mainly long-term fixed rate finances to fund its working capital and to using mainly short-term finances. Okay, in this case, finance cost will increase. No, actually the finance cost will reduce because short-term finances are cheaper. Refinancing risk will increase. Yes, that is the correct answer, because what refinancing risk means is, if you use short-term finances, since it's unstable, you need to refinance it back again. And when you're refinancing it, there can be one risk, which is basically you may not get the refinancing. On the other side, the cost of that refinancing can be higher. So that's the answer, answer B. In relation to an operating lease, which is the following? So what's an operating lease? Is different to a finance lease. So all the risks and rewards of ownership are transferred to the lessee. No, that's in a finance lease. The asset and lease obligations will be recorded. No, that's only in a finance lease. The lease period will cover almost all of the lease's economic life. No, that's in a finance lease, not an operating lease. So your correct answer is answer D. Because in an operating lease, the lessor is the one who does the maintenance. The lessee just uses it. So it's answer D. A company has annual operating profit of 2 million per year, which is expected to continue in perpetuity. The company has a cost of equity of 10% and a profit before tax cost of debt of 5% and an after tax weighted average cost of capital of 8%. The corporate tax is 20%. What is the theoretical value of the firm? But the theoretical value of the firm should be the present value of its future operating cash flow, because it's the value of the firm is the value of its equity and the value of its debt. So since it's a perpetuity, we can simply take the value and divide it by R. So in this case, what I should be taking is the operating cash flow after tax, post-tax operating cash flow, that's the 2 million, and divided by, in this case, the WACC, which is the post-tax WACC. So I have the pre-tax cost of debt, the after-tax weighted average cost of capital, that's 8%. So my answer should be 2 divided by 0.08, is that right? So this should be 2 divided by 0.08, which should give me an answer of, is there a 25 option? Yeah, answer D, which is 25. Okay, right. Okay. Which of the following would you expect to be the responsibility of the financial manager? Well, financial management is more to do with sources and uses of funds. So producing annual reports is more the accountant. Producing monthly management accountants is more the management accountant. Advising on investment of non-current assets, yes, that's more investment appraisal. Deciding pay rates, well, that is more to do with the HR functions. Yeah, right. So it should be answer C. Yeah. Question 11, loan company has in issue 3% convertible loan notes which are eligible in 5 years time at their nominal value of 100. Alternatively, each loan can be converted 5 years time to ordinary shares. The current share price of lane is 360 per share. Okay, so what we can do in this calculation is it's a convertible. So the first thing you need to do is to see whether the conversion is likely. So if I see here is conversion. So to see whether the conversion is likely, I can work the share price in 5 years. To work out the share price in 5 years, this will be basically, okay, if I just look at this will be, so share price is currently 360, this will grow at 5%. So that will be 3.6 into 1.05, and this will grow for 5 years. That should give me about 4.59 or 4.6 for value of shares. So how many shares am I going to get through this? Well, the answer is I will be getting 25 shares. So it will be 25 into what value? So it will be 114. If not converted, I will get 100. So you will notice conversion likely. So if the conversion is likely, you're going to get something like this now. So if I look at this, any investor who buys this is going to hold this investment for approximately how long? You're going to hold this investment for 5 years. So that's 1, 2, 3, 4, 5. If you do this, you get interest, and in case the interest you're going to earn on this is basically you're going to get 3% on 100, correct? So that will be 0. Equal to 0.03 into 100. So this you will for the next 5 years. Then okay, you're going to have the conversion. Remember, an investor can either get 100 back or he can get 114. So here you'd rather go for this. It's a better option. Take it as shares, which means I can now work my net cash flow. In this case will be equal to, I'll just add this plus this, then I can drag it across. It's your net cash flow. Your discount factor at. Now, what's the rate of return investors are demanding on similar risk investments? The answer is, so the pre-tax cost of debt on these loans is 10%. So the investors are demanding a rate of return on 10% on this. So I can discount this at actually 10%. So that's equal to 1 divided by 1.1 to the power of 1 and so forth. So these are my discount factors. So this is a very convenient way I work it out, because as soon as I take it to the power of this, if I drag this across, I will just get all the discount factors. So that's the present value will now be equal to this figure into this. Okay. And the market price, the value of this will be the summation now. So I can just say sum of this entire cash flow. And that should be around 82.69. So if there is an answer that says 82.69, yes, it's answer A, which is 82.71. We are close. So answer A. Right. Now this is a little complicated. Currency X uses as a currency, this thing. Okay. So this is actually testing your four-way equivalency. So you can do this calculation whichever way you want. Now I can't show you this calculation here because honestly I don't have a pen with me here. But see, if you know country, so they've told you the four-way equivalency holds, right? According to the four-way equivalence model. So if the four-way equivalency holds, either way you take it, it has to line up to the same thing. So if I already know country X's, so I already know country X's inflation, and I already know country Y X's, sorry, I already know country X's inflation rate, and I also know country Y's inflation rate, and I know country Y's nominal rate of return. So if I know country Y's nominal rate of return, and if I know country Y's inflation rate, I can work out the real rate of return through the Fisher equation. And if the four-way equivalency holds, the real rates of return between both these two currencies should be the same. And if that is the case, through that I can work out the nominal rate of return for country X. So there are many ways you can do this. Through this, your correct answer should be actually answer B, because basically if you work out the calculations, you will actually see only 1 and 2 holds, because anyway, country X's real rate of return cannot be higher than country Y if the four-way equivalency holds, because if the four-way equivalency holds, all the countries should have the same real rates of return across, because if the real rates of return are the same, there is no incentive for money to move up and down. Okay, so this is it's a 1 and 2, it's an answer B. Which of the following government action should lead to an increase in aggregate demand? Now, if aggregate demand is to increase, the components of aggregate demand should increase, which is basically consumption expenditure, or C plus I plus G, and X must increase or M must reduce. So we need to now see which of these will contribute towards each of those for aggregate demand to increase. So if I increase taxes, what will happen is consumption is going to fall. So that's not our answer. If I decrease taxes and increase government expenditure, yes, that makes sense, right? Because as soon as I reduce taxes, consumption expenditure will rise, investment will rise, and obviously if I'm increasing government expenditure, G is rising as well. So that seems the potential. We can mark that and keep. 2 seems right. Decrease in the money supply. And if I decrease the money supply, naturally interest rates to rise. So it goes back to, if interest rates are rising, consumption expenditure and investment should fall. So that's not our answer. Yes, if I decrease interest rates, I should now be able to achieve it. So I would go for an answer which says 2 and 4, in this case an answer C. Right? Is it right? Yeah. Okay. Okay. The next one. So they've given us a company's results and they're asking us for the return on capital employed. So how do you work out return on capital employed? Return on capital employed is the return on your total assets, irrespective of your assets are funded, in a straightforward sense. Because in any business, what matters is the return the asset generates, not how the asset is funded. The equity and debt shows you how an asset is funded, and how the cash flows generated on the asset depends on the asset. So what we need is, to work out return on capital employed, I need profit before interest and tax and divided by the capital employed. So that is technically 2,500 divided by, in this case, 12,500, which gives me approximately 20%. Right? So it should be answer C. Yeah. What is the theoretical value of the X rights price? So to work out the theoretical value of the X rights price, I first of all need the rights issue price. So the theoretical X rights price, so the value of a right is the difference between the theoretical X rights price and the issue price. So for me to work out the TERP first, let's try to work out my TERP. So if I'm to work out my theoretical X rights price, right, this will be, so what are they telling me? So we're going for a 1 for 4 rights issue, right? So I will, at 6, The share price before the announcement of 8. So I actually had 4 shares into 8, plus I will now have 1 share at 6. All of this, if I divide it by 5, that should give me the theoretical ex-rights price, which is around 7.6, which means the value of a right now should be equal to this value minus, I believe it was 6, which gives me 1.6. No, I will make a mistake. 1 for 4. Okay, recently announced. Yeah, should be answer, right? 0.4. Oh, they're asking the value per, sorry, they are asking the value per share, right? So yes, 1.6 is correct. Yeah. So they're asking for the value. If we look at this question correctly, they're asking us what is the theoretical value of a right per existing share. Now that's a, so if it's per existing share, this answer divided by 4, giving me now 0.4, right? So it's a little tricky thing there. The change needs to be done. Yeah. Okay, so it's answer B actually. Okay. Okay, so that's that. If you hadn't read this question correctly, would have actually edged towards that. Right, so those are your MCQs. Okay, right. So herd company is based, so again a question on Forex, right? They given you the spot exchange rates and so forth. Okay, what is the 6-month forward exchange rate predicted by interest rate parity? Now interest rate parity argues that so to work out interest rate based on interest rate parity shows me what the 6-month forward rate is. Now the challenge here is back again, if it's so many euros per dollar, the dollar is the base currency, and in your equation always the currency which is the base should be the denominator. Okay, what I mean by that is, if I want to work out the 6-month forward rate, I need to first of all, if I now try to work out the 6 months forward rate, this will be equal to, do I know today's spot rate? Do I have it? The spot exchange rate is 1.543. So that's what I need. So that is 1.543 into, now the base, remember, was the dollar. So I need the rate, I need the 6-month rate of the euro. So now we need to be careful. The domestic is the dollar, the foreign is the euro, and they're telling me the spot exchange rate, the domestic short-term rate, but the foreign rate is 5. So the euro is 5%. For 1 year, which means for 6 months, that's into 1.025. Am I right? Because it's 5% for 6 months, for 1 year, right? Yeah. Yeah. This entire thing, I will divide it by the return of the dollar, which is 1.01, because if you see it, it's actually 2% per year. So this should be my answer, which gives me 1.01. 5.6 approximately. Answer C. Okay. As regard to the euro receipt, which of the primary nature is a risk faced by HERD? So what is HERD? So what's happening? You're receiving some money from a foreign customer, which makes it a transaction risk, because you've done a transaction and you're getting money in the future. You're not sure how much it will actually convert to. Which of the following heading method is not favorable for hedging the euro receipt? Right. Well, currency swaps do not work here, simply because in a currency swap there is a exchange of money at the beginning, during, and at the end, and that's not happening here. Everything else can be used. Which is the following statement suppose the finance directors believe that the euro will depreciate against the dollar? Well, if the dollar inflation rate is greater than the euro inflation rate, well, if the dollar inflation rate is greater than the euro inflation rate, honestly, which the following statement suppose the finance director believes that the euro will depreciate? So actually the euro cannot depreciate against the dollar if the dollar inflation rate is greater than the euro rate. So if the euro rate is inflation rate is higher, we would actually expect the euro to depreciate. So that statement is out. Number 2 says the dollar nominal interest rate is less. So if the dollar nominal interest rate is less, yes, the euro will depreciate because the dollar should depreciate. So it's answer 2. As regard to the interest rate faced by HERD, which of the following statements is correct? In exchange for a premium, HERD could hedge the interest rate by buying interest rate options. Yes, you can. Buying a flow. Buying a flow will help HERD hedge against interest rate increases. Actually, you will not buy a flow there. You should be buying a cap. The cap prevents interest rates moving up, and a flow prevents interest rates falling. So flows are generally taken by depositors, not borrowers. Third company can hedge its interest rates by buying interest rate futures. No, arguably you should be selling interest rate futures. How do you always determine whether to buy or sell interest rate futures? Well, if you can always think of it if you're a borrower, you need money, and if you need money, you need to sell bonds to collect money. So selling bonds is equivalent to selling interest rate futures. So borrowers always sell interest rate futures, depositors always buy interest rate futures. And in this case, you can't be buying interest rate futures because you're a borrower. And taking out where the answer D is out. Right. The next one relates to, again, sources of finance. It says, using the dividend growth model, what is the market value of each ordinary share? Now, to work the market value of each ordinary share, what I basically need is, okay. So notice here, they haven't given me the growth rate in dividends, but from 2002 to 2006, dividends have steadily grown, and we can assume it to have a steady growth. So if I were to work this growth rate, something which started at 3.7 has now gone up to 4.5. Over, though it's 1, 2, 3, 4, 5 years, it has compounded only 4 times. From that to that is 1, 2, 3, 4, and so forth. Yeah. So I can work the growth rate in dividends like this. So the growth rate in dividends, so growth in dividends will now be equal to, how do I do this calculation? It will be 0.4 naught divided by 0.37 naught. 0.45 naught It's 0.45 naught divided by 0.37 naught to the power, or I have to take the fourth root, which is equivalent to the power 0.25. So this should be, yeah. So it's approximately about 5 point, have I got the figures right? 0.4545 divided by 0.37. 0.45, which is about 5%. So G will be basically this minus 1. So it's about 5%. So then the share price I can work out as D naught, today's share. Do I know the value? Yes. Today's share price is dividend is 0.45. So that's 0.45 into 1 plus the growth rate, that's that, divided by, do I know the return on equity of this company? Yes, the return on equity is 10%. So that's 0.1 minus growth rate. And this should be my answer, which is about 9.48. Yeah, around 9.45. That's an answer which we have. So 9.45, answer C. What is the market value of each loan note? Now, to work the market value of each note, all I need to do is, I'm not going into the detail, okay? So if I'm to work out the market value of each loan note, the value of each loan note will be the present value of the future cash flows. So the loan notes are renewable in 7 years and their nominal value is 100, you're paying interest of 6%. So the loan notes will work like this. It will be, so the loan notes will be here 1, 2, 3, 4, 5, 6, and 7. I'll just take a net cash flow straight away. Here, every year you're paying 6, I believe. Okay. And here you're redeeming back at 106. Your discount factor, how much is the return investors are demanding on this? Well, do we have scenarios? Okay, 100, 6%. So we have a pre-tax cost of debt. The pre-tax cost of debt of 4% means investors are demanding a rate of return of 4% on the debt, because if they can invest elsewhere and actually get a 4% return. So I will discount this at 4%. So which means if I'm going to discount that at 4%, 1 divided by 1.04 to the power of 1 and so forth. Those are my discount factors. Now in your exam, what you could have done was, since you have a perpetuity here, or an annuity here, you could have used the annuity factor. Yeah? So present value will be now to that figure into that. And the value should be now the summation of all of this. So if I just take the sum of all of these, the sum of all of these present values should actually be the market value of the debt, which is around 112. Yeah, do we have an answer like that? Yeah, there is it. Answer B. The finance director has been advised to calculate the net asset value of the company. Which of the following formula calculates correctly the net asset value? Well, to work out the net asset value, total assets less current liabilities. Now non-current assets plus net current assets. No, non-current assets plus current assets less total liabilities. Yeah, that makes no sense. Answer C. Yeah. Which of the following statements about the value of both valuation methods is correct? The earnings yield method multiplies earnings by earnings yield. No, it doesn't actually. The correct answer here should be the dividend valuation model makes the unreasonable assumption that the average dividend growth is a constant. Right? The equity market value is the number of shares multiplied by the share price plus the market value of debt. No, that statement would have made sense if they had asked you the total market value of the firm. So the correct answer here is answer C. Which of the following statements about capital market efficiencies are correct? Inside information cannot be used to make abnormal gains in a strong form efficient market. Yes, that's correct. In a strong form efficient market, investors cannot make super above average returns consistently by using inside information, because that information is already reflected in the price. So buying and selling creates fair gain. In a weak form efficient capital market, ring company share price reacts to new information day after it is announced. No, weak form markets are the ability for you to make above average returns by using historical information and past patterns and trends. So that doesn't make sense. C says ring companies share prices react quickly and accurately to new released information. Yes. So in a semi-strong form efficient market, prices must react accurately or speedily and accurately, quickly to the release of new information. So that's correct. So we go for an answer 1 and 3, which is basically an answer B. Right? Okay, so back again to NPV based calculations. What is the payback period for this project? So to work out this payback period, one of the easiest ways could be to actually work out the cumulative cash flows. So if I want to work the payback for this investment, okay, so I can take the year. So that 0, 1, 2, 3, 4, the cash flow. So the cash flow in year 1 will be basically, I am trying to lay down 3.9 million. So that's minus 3 million, or let's say 3.9, I take it other. Yeah. In year 1, my cash flow in millions will be 1.2, correct? Will be 1.2, 1.5, 1.6, so 1.2, 1.5, 1.6, and finally 1.5 or 1.68 because of the scrap value as well. I can now work out a cumulative. So the cumulative will be basically in this period, it's this. Here the cumulative will be actually this plus this. So every year I am now recovering investment, and you can actually see that somewhere after the 2 years into the 3rd year I have actually recovered. So it's 2 plus something. So it's 2 years, and well, I need to get another, in this case 1.2 to break even. But in this period I'm getting 1.6. So if I can roughly work it out as, I'll just convert this minus into doing that way, divide that by this, because this is how much I'm getting over 3 years. So which means it's around 0.75. So which means it is actually 2 years, or it's 2.75 years. Do I have an answer that's like that? Yes, there it is, answer A. Based on the average investment method, what is the return on capital employed? Now, if I'm to work out the return on capital employed, first of all, I need to work out my average investment. So I'm now trying to work out my ROCE, or call it an ARR, whatever you want. I need my average investment. So my average investment will be basically the investment at the start, that is 3.9, plus the investment at the end, I believe it was 1. Yeah, or not 1.1. Okay, this entire thing I will just divide it by 2 because it's at the beginning and the end. That's that. My average profit. Now to work out my average profit, this will be basically equal to, in this case, this value plus this value plus this value plus, I'll take, well I just put that separately, which is 1.58. Okay. From this, I will minus the total investment, why I need the depreciation. So the total depreciation here will actually be 3.9 minus 1, which is 0.1, which is 3.8. That's the total depreciation. Minus 3.8. That entire thing, I will average it over 4 years. So that's the average profit per year is so much. Therefore, my ROCE, or return on capital employed, will be now basically this divided by 2, which should give me around 26%. Do I have an answer like that? Yes, it's answer B. Right. Which of the following statements about investment appraisal is correct? The return on capital employed method considers time value of money. No, it doesn't. The return on capital employed must be greater than the cost of equity if the project is to be accepted. Not really. The return on capital employed just should be above a target return on capital employed of a management. The IRR should be above the cost of capital. That's different. Riskier projects should be evaluated with longer payback periods. Actually, more risky the project, you will want quick wins. You want to actually have a quicker payback. Payback period ignores the timing of cash flows within the payback period. Yes, it does. Okay, so your appropriate answer there is a D. Which of the following statements about French companies are correct? Manager rewards schemes of listed companies should encourage the achievement of stakeholder objectives. Yes, that's good governance. Requiring investment projects to be evaluating with return on capital employed is an example of dysfunctional behavior encouraged by performance related play. Yes, it is, because what happens is if you're trying to evaluate a project based on return on capital employed, what a manager may be forced to do is actually reduce the investment, because reducing the average investment could actually increase your ROC, but in the long term you're going to have problems. Fence company has an agency problem as the directors are not maximizing the interest of the wealth of shareholders. Yes, so I would say it's an answer 2 and 3, which is C. Which is the following statement about Fence company's directors remuneration packages are correct? Directors remuneration should be determined by senior executives. Not at all. Directors remuneration is important for there to be independence and for it to be decided by a non-executive directors, part of your remuneration committees, right? Introducing a share option scheme will help directors' objectives in line with shareholders' objectives. Yes, because as soon as you give them share options, you're giving them the option to buy shares in the future at a predetermined price. So they'll have a motivation to actually increase share prices in the future too, so that they will actually make a gain in the process. So that seems correct. Linking financial rewards to a target return on capital employed will encourage short-term profitability and discourage capital investment. Yes, that answer seems correct. So it's only 2 and 3. So it's answer C. So that's that. So we now come to the last part of this. Yep. So the first question is a little bit about working capital management. Yeah. So let's just let's just quickly take a peek of it. Evaluate whether in company should accept the early settlement discount offered by its supplier. So what do we have here? This company has offered the company an early settlement discount of 5% for payment within 30 days. Administrative cost will increase, however, by 500 per year if the early settlement discount is taken. In company buys components worth 1.5 million from this supplier. So if we look at this, why take the discount? So I work it here, the benefit. The benefit of taking this discount will be that 1,500,000 into how much is the value of the discount here. The discount is, I'm getting a discount of 0. Or early settlement discount of 0.5%. So 0.5% is 0.005. Right? That's the benefit. But the cost, now the cost is this. If I take this discount, my creditors level will fall, and if the creditors level falls, I need to fund my creditors through another source of finance. In this case, I suppose a bank overdraft. So my current creditor level. So my current creditor level here will be, what do I have? 1,500,000 divided by, we need to be very careful to see whether it's a 365 or 360 day. 360 day year. So divided by 365. 365 or 360. 360 into how much am I currently taking to pay? I believe 30 days or 60 days, which I'm trying to pay in 30 days. So currently I am paying in 60 days. So that's that much. New creditor level. Well, if I'm paying in half this period, if I'm paying in 30 days, this should actually happen, right? So which means it's still 1,500,000 divided by 360 now into 30. So you can actually see it has reduced by half. So the reduction. So the reduction will be basically equal to this minus this. This is what I need to finance through an overdraft. So I need to double check and see how am I funding this. So the company finances working capital with an overdraft of 4%. So bank BOD funding. Now I have to, for this, I have to pay at the rate of 4%. On top of this, I have also got to incur admin cost. Because they said to get this thing off, you've got to pay also 500 per year. So that's another 500 on top of this, so you would incur. So I can work out my total cost. So the total cost will be basically this plus this, which means that's my benefit, that's my cost, which means I can work out the net benefit to be this minus this. Well, I'm 2,000 better off. So it is financially, purely on a financial ground, it's justifiable. Even on a non-financial ground, it is justifiable because you build stronger relationships with your suppliers and so forth. Right. Evaluate whether in company should adopt the economic or the quantity approach. So for us to determine whether you're to adopt the economic or the quantity approach, we should first of all look at whether what's our current approach. So I will just work out here what is our current order procedure. So my current ordering, what do I know? So You are purchasing 2.4 million per year of component K at a price of 5 per component. So I can work out number of units a year. So the number of units I'm actually buying a year will be equal to 2,400,000 divided by 5. So 2,400,000 divided by 5, I'm buying around 480,000 units. How am I buying this 480,000 units a year? It tells you at a constant rate probably. See, because it's constant, I can actually use that EOQ. The company orders components at the start of each month. If you're buying at the start of each month, number of orders a year is actually 12. So order size then by default has to be this divided by this. So then I can play around with some numbers. My order cost. So my order cost will be, I'm placing 12 orders a year. Each order is going to cost me, 248.44. And my holding cost here will be equal to my order size at any point is this. So I will order this much of quantity. At the end, it will be 0. So it averages to this plus 0 divided by 2. That, and every unit is costing me roughly. Every unit is costing me roughly costing me roughly 1.06 to hold. Okay, so equals, right. So total cost. So the total will be now to that holding cost plus the ordering cost. That's my total cost. So can I beat this through the EOQ? Let's see. So I know the EOQ, the formula 2 into D into CO divided by CH square rooted. So what's my economic order size? 2 into what is my demand? Well, my demand is so many units a year into each order costs me roughly 248.44 divided by each unit costs me how much to stock per year. I think it was 1. 1.06. I take the square root of that. So that to the power 0.5. So that's my EOQ, roughly about 15,000 units to be ordered. So if I order these 15,000 units, my holding cost and ordering cost should be the same. So if you actually get it the same, you're technically right. So let's say order cost. So the order cost now will be, that's the amount of units I need a year. If I divide that by that, that's the number of orders. Each of these, each order is now going at, I don't remember that value, but it goes as 248.44. That's your order cost. Your holding cost should be logically equal to that divided by 2, and each of these is going to cost you 1.2, 1.06 to hold. So you can see it is equal. So that's your answer is correct, which means the total should be logically equal to that plus that, which means it's that. So which means earlier my total was that. So the saving my saving should be technically that minus that, be saving around 8,281, which is actually, sorry, is it right? No, it's correct, right? Yeah. So there is a net saving, which actually makes sense. Okay. Right. Critically discuss how N company could improve the management of its trade receivables. Well, if you want to manage your trade receivables, just like I showed you in the slide before, have a policy with regard to your debtors, have in place proper credit screening procedures, have in place proper invoicing and monitoring procedures, and have proper collection procedures. Discuss that. Lastly, investment appraisal. So a lot of data given. So now okay, let's see what our requirements are. Calculate the net present value of the investment project in nominal terms. What does nominal terms mean? With inflation. So the important thing to understand is if you're calculating anything in nominal terms, you should be taking the nominal cost of capital. If you don't have the nominal cost of capital and the real, you can use the Fisher equation and make that adjustment. Discuss how the capital asset pricing model can assist. So the CAPM, how can it assist in making a better investment decision with regard to the new product launch? Well, I'll come to that, but why that's given is you would actually see this company is actually launching in a new product in a new market. So if you're actually going to a new market, you're entering a different risk, and that project cannot be evaluated with the risk of your existing assets in place. So you need to work out a project specific rate of return. So we'll come to that. So first of all, since I have to work out the nominal cost of capital, I will work on the basis of inflation here, right? So first of all, I'll work out I will actually work on, I will do some workings. So my working one, I'll work inflation adjusted cash flows. Okay, so to work out the inflation adjusted cash flows, first of all, let me work. Okay, so year for selling price. So what have they told me about the selling price now? Okay, the selling price is, so forecasted sales volume, selling price, and variable cost are as follows. So these are based on today's values. So selling price and variable cost here are given in current price terms before taking any forecasted selling price inflation of 4%. So what we're talking about is this 15, which is today's terms, but next year with inflation, this should grow at 4%. Right? Now this 18 is at today's terms, this should grow at 4% squared. So this is what I can now replicate. So this figure will be logically equal to 15 into 1.04 to the power of 1. This figure should be logically 18 into 1.04 squared. This figure should be equal to 22 into 1.04 to the power of 3. This figure should be equal to 22 back again into 1.04 to the power of 4. Right. Same way I can do the variable cost. So the variable cost inflation will be, so the variable cost, that's easy, that's a constant 9 and that's growing at 5%. So I can do this. I'll take it as a minus because it's a cash outflow. That into 1.05 now to the power of 1. So that if I drag this across, it will be multiplied by 2, 3, 4 and so forth. So it will look like that. Okay, it's 5%, yeah. Also fixed cost, incremental fixed cost. So the incremental fixed cost is every year, the incremental fixed cost is 500,000 and that is 8%. So that is minus 500,000 into 1.08 to the power of, in this case, 1. So if I drag this across, to make matters easy, I will also take the number of units here. So that in my NPV calculation, I can just multiply those and take it. Then life is much kind of easier. So that's 200,000, 800,000, 900,000. So that's 200,000, 800,000, 900,000, and 400,000. Right. Okay. Now, what else have they told me? So I know that. Okay. Initial investment. Okay, I know the 2.5 million. It was seized. There's a scrap value. Working capital. So I need to do a separate calculation for my working capital, investment in working capital. Okay. So to work this out, I need to work out my working capital investment. So for my working capital investment, here's the year. So 1, 2, 3, 4. I'm just looking at for each year, for my first year, how much of working capital I need. But that investment has to be made in year 0. So I'll address that separately. I need to work out what is my working capital that I have to have in place. So in year 1, I need to, for my year 1, I have to have working capital of 1,500,000. So I just put that figure down. So I'll take it as a minus because the cash outflow 1,500,000, and this working capital is also expected to move in inflation, which is 6%. So this will be equal to this into 1.06 to the power of, oh, hang on. This working capital I will have to have, this is at today's values, right? Yeah. No, this is, if I'm putting this today, it's at today's value. So this is for the next period. So that's correct. It'll be this into 1.06 now to the power of 1. So it'll actually go like this. Okay. right? So let me just double check this. 159, 1590. Let me do this like this. That's the first year. Yeah, it's easy actually. I can just keep increasing it just every year by 6%. That's it. So this will be equal to this into 1.06. So that I can just drag this down, then at every year it will increase by that amount. Okay. But in working capital, what we need is the increment. So what this means is, though I've invested this much, I don't have to invest this. I just have to take the difference. That's it. So that's exactly what I'm going to work on now. Oh. So incremental. So the incremental value this year, I have to put this. This period's incremental value will be this minus this. So every year, that's how much more I have to put in. Okay. And in the final year, they've spoken about a recovery. So this is how much I'm going to recover in the end. Okay, as well. Okay, so that's the amount of working capital I need to put in place. Lastly, there is also capital allowances. So it says the company can claim tax allowable depreciation on a 25% reducing balance basis on the initial investment cost, adjusted in the final year of operation with a balancing allowance or a charge. So my investment cost is 1,500,000. Sorry, not 1,500,000. It's 3.9 million, I believe. Where is it? $2.5 million. So I'll do that calculation. So my capital allowance. So to work out my capital allowance, I will have the year. I will have the balance. I will have a capital allowance and a tax shield. Okay. So the year will be 1, 2, 3, 4. My balance will be 2,500,000. On this, I will get a capital allowance at the rate of 25%. Okay. And because of that, I will save taxes at the rate of, in this case, at the rate of 20%. Okay. So then my balance in this period, since it's reducing balance, it will be this minus the capital allowance. On that, I will get a, so I can just keep dragging this because it's the same figure that applies here also. I can just keep dragging it because it's the same figure that applies. Okay. So would this, now if there was no scrap value, I will get this entire thing as a capital allowance in the next period as well. Okay. But since there is a scrap value, I am going to only get a balancing allowance, and this is what we call the balancing allowance, right? My scrap value on this machine is 125,000. So from this, I will minus 125,000 which now gives me a balancing allowance. So I just keep saying this, if you do add this up, this should be how much your net investment has been, and this is how much the government will actually let you write off as an allowance. Yeah. So, but what matters to our calculation now is this. So we have all our calculations to now go ahead. So now we can create our NPV. So as usual, we take the year. So year 0, 1, 2, 3, 4. I don't need a 5 because taxes are payable in the same year. Investment. So the investment will be in this period, it's a minus 2,500,000. My revenue. So I will say working one, if you want to call it like that. So my revenue will be basically in this period, this selling price into the number of units. Okay. So if I actually drag this across, it should all tally the same way. Just double check it. Yeah, there you go. Right. My variable cost, again, working one, that should be equal to that variable cost into the number of units. Just drag that across. My fixed cost, this should be equal to, well, I have that figure here, so that I can now just drag that across. Okay. Then I can work my operating cash flow. That will be, well, I can just sum all of these because I've already treated some as minuses. Remember not to minus it because then you'll be adding it actually. That's why I deliberately took it as a minus. That's that. Then tax on the cash flow. Same year, so that will be that into 0.2. Again, you can treat this as a minus. Then you get it comes as a minus. It comes as a cash outflow. Okay. Then to this, bring your tax shields. You can call it. You can cross-refer the working. So that's a tax shield of that much. In this period, it's a tax shield of this much. In this period, it's a tax shield of this much, and so forth. Okay. Then, once you've done this, you can now bring in your values which does not affect your tax. That's why I did not take the working capital before. Now, let's bring the working capital in. Now, in the working capital, in year 0, I will have to actually invest this amount. Then in year 1, I will have to incrementally put this amount. Then in year 2, I'll have to incrementally put this amount, and so forth. Year 3, I'll have to incrementally put this amount. And finally, the recovery. So again, double check. If you just add this across, since you invested and you recover it fully at the end, this should logically add up to 0. There you go. That seems correct. Okay. Then also bring your scrap. Okay, and your scrap value, I believe, was 1,500,000, was it? 125,000. Now I can work my net cash flow. So my net cash flow here will be equal to this plus this. My net cash flow here, let's see, I'll take my operating cash flow plus the tax. So I'll add these. Because there are pluses and minuses anyway. I'll just add this as well. Then I can just drag it across. So that's my net cash flow. Discount factor. Now the discount factor, remember, since we worked on nominal cash flows, we need to be working on the nominal cost of capital. What have we been given? So Nominal after tax, that's what we need. Nominal after tax cost of capital of 12%. We don't need the real cost because we've not worked on real cash flows. So I need to take it as 12%. So that's at 12%. So that will be equal to 1 divided by 0.12. See, very easy to take it like that, so that as soon as you drag it across, you get your discount factors with ease. Okay. Then present value, that will be basically that figure into that. And finally, your NPV will be the summation of all of these, which is that much, which is a decent project. Yep. So the NPV is financially acceptable because it's NPV is plus, but obviously in real life, we look at certain non-financial aspects, some of these projections and so forth. Right, so that is that. Lastly, discuss how the capital asset pricing model could help the company in making. So like we discussed, or like I said, this company is entering a new investment domain, a new market. It's very difficult for you to use your existing weighted average cost of capital because that weighted average cost of capital represents the risk of your current assets in place. So if the company is actually looking at an investment that has a different risk to your current assets, and actually if that investment's risk is much less, by using this WACC of 12%, you may be actually saying goodbye to a good project which is under investment. And that's what I kept explaining at that time. So we need to work out a rate of return that is specific for this investment. So the easiest way to do this is go through this process called geared and ungeared beta. So since we are now entering a new product in a new market, we can look for a proxy company that is already in that market with that product. Perfectly, you should be picking up a pure play company. A pure play company is a company that has only that's only in one market, because if you take something like John Keys, it's very difficult to do because they're in multiple markets. So what you can do is you can take that company's that pure play company who's already a proxy in that market you're trying to enter. If you analyze that company's stock market data, or if you regress that company's share price against a benchmark index, you can work out something called that stock's equity beta value. Now, if two companies are in the same industry, their asset betas are same, or the beta of their assets or the activity is the same. So therefore, I can now take the equity beta value and convert that equity beta into an asset beta by applying that company's debt to equity ratio. Once I've got that company's asset beta, I can now use that company's asset beta to evaluate the investment I am trying to make, because our business risks are now going to be the same. And that's the way that question can be answered. And that brings me the end to that paper. And you can always see, in case of doubt, most of these equations are now given in your exam. Right. Any questions on that? Yeah. Right. So I'd like to conclude that session because that's what I wanted to do for the day. All the very best for exams and do well. Thank you.